Welcome, ladies and gentlemen, to the Cima SCS P3 Complete Essentials Revision, segment number 7. This is actually part 1 of segment number 7. Is going to be a very crucial aspect as far as risk management is concerned. Let's have a look. Internal audit. So before I get started, a quick reminder on my suggestions. Please have a notebook and pen on the ready. Follow the slides and my explanation carefully. Make notes as you deem necessary. Maintain a list of key topics that you feel you're weak at so you can self-revise later. And also maintain a list of key performance and management tools that can help model answers in the strategic case study exam. On that note, we can get started. But quick reminder as always on the core activities. As you know, the core activities that are related to P3 are D and E. D being evaluate and mitigate risk. E being recommend and maintain a sound control environment. And if you consider internal audit in itself, as you can see, apply internal audit resources. So that's the fundamental task that relates to core activity E that we are going to look at in this segment. All right. So first we need to understand what management review of internal controls are, or basically how it happens. The UK's Turnbull Committee report says that a review of internal controls should be an integral part of management's role. The board or committee should actively consider reports on control issues like the identification, evaluation and management of all key risks facing the organization, the effectiveness of internal control, financial, operational, compliance and risk management controls. All of these, are they actually working? Communication to employees of risk objectives with targets and performance indicators. The action taken if any weakness is found. And the report continues to recommend that the board should consider the nature and the extent of the risks which face the organization, the threat of those risks occurring, and the organization's ability to reduce the probability and consequences of those risks and to adapt to any changing risks, including the costs and benefits of any controls implemented. So what basically I'm trying to communicate through this slide is that it is a critical task that falls under the responsibility of the management, that they have to have a good handle on how the internal control system operates within the company. So conducting management reviews, staying on top of the game as far as internal controls are concerned, is critical to a business's success. That brings me to the discussion on the core discussion on internal audit. What is IA? What is internal audit? Internal auditing is an independent and objective assurance activity designed to add value and improve an organization's operations. It helps an organization accomplish its objectives by bringing a systematic approach to evaluating and improving the effectiveness of risk management, control, and the governance process. Internal auditing improves an organization's effectiveness and efficiency by providing recommendations based on analysis and assessments of data and business processes. So it tries to improve organizational effectiveness and efficiency. Internal auditing provides value to governing bodies and senior management as an objective source of independent advice. And the scope of IA within an organization is very broad, and it could involve topics like the efficacy of operations, reliability of reporting, deterring and investigating fraud, safeguarding assets, and compliance with laws and regulations. Internal auditing frequently involves measuring compliance with entities' policies and procedures. However, the internal auditors are not responsible for execution of the company activities. They advise the management and the BOD. So basically, they provide an oversight function rather than an execution function in itself. And what do they provide oversight on? On how to better execute their responsibilities. An internal audit function therefore acts as internal control to ensure that the internal control system is operating effectively. So it's an oversight system to ensure that the internal control system is functioning effectively. Now let's talk about risk management versus internal audit. Risk management, obviously we've looked at it in segment number 2, but here we want to look at it in the context of internal audit. So a quick recap: a risk management team would be considered to own the entire risk management process. They would be ultimately responsible for all the aspects of this process, including identification and maintenance of the risk register, assessment, prioritization, treatment of risks, and establishment of controls to manage those risks. And the team would lead the company in developing a risk response strategy and would act in an advisory capacity, supporting all the areas of business. So this is what the risk management team would be undertaking, extensively discussed in the risk management segment. Now, internal audit, their role is that of monitoring and reviewing the effectiveness of the controls implemented by the operational managers. Now, when we apply this to the context of risk management, the internal audit's key activity is in the testing and evaluation of the risk controls. Hence, they ensure that those who design the controls shouldn't test them. Right? So that's why we separate. We never get the internal audit team to basically suggest controls, because if they suggest controls and if they are the ones who design them and implement them, then reviewing those also falls in their or within their scope of responsibility. So it will be a self-review. That is why there is a clear distinction between who is in charge of risk and who is going to review those risk controls. In this case, internal audit. In a wider context, the internal audit department can carry out special investigations as directed by management and can assist the organization in review of the efficient use of resources. Internal audit teams can provide support and assistance to senior management in a range of projects, some of which may fall outside the risk management arena. They are often able to contribute to the work of operational teams in identifying risks due to their extensive knowledge of the business. But this is not their primary responsibility. It's one of their secondary responsibilities in terms of additional assistance. In fact, as we go along, you'll learn that there are so many other things that internal audit can support the company with. If you look at a contextual snapshot of internal audit in the context of overall risk management, which is P3, risk management identify the risks or problems, and the management devise controls which they think will prevent the risk or problem, and the auditors check that the control works. So it's very important you have a very sound understanding of risk management, the management, what their responsibility is, and the auditors, what their responsibility is. If it doesn't, then it is still a problem and management will implement further or different controls which audit will check again. So the process goes on until the risk or problem is minimized to the satisfaction of management. This gets repeated to ensure it is within the company's attitude to risk. There are 3 different parties involved in the process review: risk management team, managers, and the auditors, to ensure independence and the best solution for the company. So even in corporate governance, you will notice that one of the fundamental principles embedded in corporate governance is called segregation of duties, segregation of responsibilities, not only at the board level, but across the company. You need that segregation of responsibilities, because this is a classic example where then independence is safeguarded and therefore objectivity is ensured. Factors affecting the need for internal audit: the scale, diversity, and complexity of the company's activities, the number of employees, cost-benefit considerations, changes in structure, reporting processes or underlying information systems, changes in key risks that could be internal or external in nature, problems with existing internal control systems, an increased number of unexplained or unacceptable events. These are all various factors that would highlight the need for internal audit. Now, where there is no internal audit department, the management needs to apply other processes monitoring ones in order to assure itself and the board that the system of internal control is functioning as intended. In these circumstances, the board will need to assess whether such procedures provide sufficient and objective assurance. If that is not the case, then it's high time that that particular company sets up an internal audit department or division. What's the scope of internal audit work? So this snapshot here that you see is a good summarized view on the kind of scope that internal audit covers. So internal audit reviews economy, efficiency and effectiveness of operations. They examine financial and operating information. They do the testing part. They review accounting and internal control systems. They assist in carrying out external audit procedures. They also assist with identification of significant risks, and they conduct special investigations whenever they are commissioned, and they review compliance with laws, regulations or internal policies. So compliance testing also is an area they do. This is the scope of internal audit and the actions and the functions that internal audit can undertake. Now we are looking at the standard of internal audit work. The internal audit function would be expected to carry out their work to a high professional standard. Therefore, the audit function should be well managed and have clear and appropriate procedures for carrying out its work. There is a formal plan of all audit work called the audit plan that is reviewed by the head of audit and the board or audit committee. It is generally expected that the audit plans should be reviewed at least annually, and each engagement should be conducted appropriately. Planning must be performed, objectives should be set for the engagement, the work should be documented, reviewed and supervised, the results should be communicated to management, recommendations for actions should be made. All of this must be conducted properly, and the progress of the audit should be monitored by the head of internal audit, and if recommendations that the head feels are appropriate are not acted on, the matters should be brought to the attention of the board. This is the standard of internal audit work. Now, while logically, when you look at the standard, obviously there is a high standard expected, there are additional considerations here. Basically, there are international standards for internal audit issued by the Internal Audit Standards Board, the IASB of the Institute of Internal Auditors. Now, they basically pitch two types of standards. The first one is attribute standards, which deal with the characteristics of organizations and the parties performing internal auditing activities. So under attribute standards, you have standards like independence, objectivity and professional care. Independence is where the internal audit activity should be independent, and the head of internal audit should report to a level within the company that allows the internal audit activity to fulfill its responsibilities. It should be free from interference when deciding on the scope of its assurance work, when carrying out the work, and when communicating its opinions. Objectivity is where internal auditors must be objective. They should have an impartial attitude and should avoid any conflicts of interest. For example, an internal audit should not provide assurance services for an operation for which he or she has had management responsibility within the previous year. Professional care is where internal auditors must exercise due professional care and should have the competence to perform their task. If this is not there, it's going to be a mess. They should have some knowledge of the key IT risks and controls and computer-assisted audit techniques. The next type of standards by the IASB is the performance standards. These describe the nature of internal auditing activities and provide quality criteria for evaluating internal auditing services. So under this, the management of internal audit, where the head of internal audit must manage the audit activity to ensure that it adds value to the company, and must establish risk-based plans to decide the priorities for internal audit work consistent with the organization's objectives always. Then the risk management aspect. IA should identify and evaluate significant risk exposures and contribute to the improvement of risk management and control systems. It should evaluate risk exposures relating to governance, operations and information systems, and the reliability and integrity of financial and operating information, the effectiveness of and the efficiency of operations, and safeguarding the assets, laws, or the compliance with laws, regulations, and contracts. All of these already discussed within the risk management scope. IA must identify, keep an eye on the risk level, and ensure that any changes they note are communicated. Then control. IA should assess the corporate governance process and make recommendations where appropriate for improvements in achieving the objectives of corporate governance. Then the governance element itself, where IA should assess the corporate governance process. So I'm taking you through the governance aspect. The governance performance standard is where IA should assess the corporate governance process and make recommendations where appropriate for improvements in achieving the objectives of corporate governance. Then we have the control aspect, where IA should help to maintain the organization's control system by evaluating the effectiveness and efficiency of controls, and also by promoting continuous improvement of the internal control systems. So there was a slight change in the point. First we looked at governance, and then we looked at control. Then you have the standard performance standard of internal audit work, where IA should identify, analyze, evaluate, and record sufficient, reliable, relevant, and useful information to achieve the objectives of the engagement. Then you have communicating results, where results of IA's engagement, including conclusions, recommendations, and action plans to appropriate persons, must be done in a proper, timely, and accurate manner. These are the performance standards of internal audit work suggested by or pitched by the IASB. That brings me back to the structure and independence of internal audit. Now, to ensure that the IA function provides an objective assessment of control systems and their weaknesses, there should be measures in place to protect the independence of the internal audit department. Because if they are not independent, they will not be able to competently discharge their duty. So the internal auditors should be independent of executive management while having direct access to the highest level of management when needed, and also should not have any involvement in the activities or systems that they audit. Basically, they must be free from operational responsibility. So they are fundamentally an oversight team, not an operational team. The head of internal audit should report directly to a senior director. In addition, however, the head of internal audit should have direct access to the chairman of the board of directors and to the audit committee, and is accountable to the audit committee also. The audit committee should approve the appointment and termination of appointment of the head of internal audit. And in large organizations, the internal audit function will be a separate department, while in a small company, it might be the responsibility of individuals to perform specific tasks, even though there will not be a full-time position related to internal audit. So it will be, if it's a small company, small team, you can embed small internal audit functionalities within the daily and weekly and bi-weekly tasks themselves. Some companies outsource their internal audit function often to one of the large accountancy firms. So there are firms that provide internal audit activities. The internal auditor will review the accounting and control systems, perform testing of transactions and balances. They will also review the 3 E's: economy, efficiency, and effectiveness, the implementation of corporate policy, carrying out special investigations, and assist the external auditors where necessary. And they should be technically competent, and they must exercise due professional care by planning, supervising, reviewing any of the work performed, and they must maintain documentation and communicate the results, also the recommendations. So this is how the structure and the independence of internal audit can be maintained. Now, there was a point mentioned that you could outsource internal audit. So let's take a look at outsourcing internal audit, what kind of advantages will there be? So directors could consider that outsourcing the internal audit function represents better value than an in-house provision. Local government authorities are under particular pressure to ensure that all their services represent best value, and this also may prompt them to decide to adopt a competitive tender approach in getting internal audit activities and support from outside parties. The advantages: there will be greater focus on cost and efficiency of the internal audit function. Staff may be drawn from a broader range of expertise. Risk of staff turnover is passed to the outsourcing firm. Specialist skills may be more readily available. Costs of employing permanent staff are avoided. May improve independence also. Access to new marketplaces, place technologies, example, audit method softwares without associated costs. Because if they are a specialist internal auditor, they will have access to all this and they will utilize them, while we don't have to go through the hassle of implementing them in-house. And reduced management time in administering an in-house department. So there are significant savings in terms of administration cost, administration time, etc. But what are the risks of outsourcing internal audit? There could be possible conflict of interest if provided by the external auditors. Pressure on the independence of the outsourced function due to a threat by management not to renew the contract, etc. Risk of lack of knowledge and understanding of the organization's objectives, culture or business, because they are really not part of the inside culture, inside game. They are anyway a third party. The decision may be based on cost, with the effectiveness of the function being reduced. The flexibility and availability may not be as high as with an in-house function. And there could be a lack of control over standard of service. There could be a risk of blurring of roles between internal and external audit, losing credibility for both, especially if the same company, same firm is providing both the services. How do you minimize these risks of outsourcing? There are a number of things we can do. You can have controls over acceptance of IA contracts to ensure no impact on independence or ethical issues. There can be regular reviews of the quality of audit work performed. There can be separate departments covering internal and external audit. There can be clearly agreed scope, responsibilities and reporting lines. And even the performance measures, management information and risk reporting can be decided very clearly. There can be procedure manuals for internal audit. So these are some of the methods that we can deploy to ensure that some of these key risks of outsourcing internal audit, if we were ever to consider that, are minimized. That brings me to the ethical threats to independence of internal audit. So this is a very important area, especially with the case study, because you see continuously situations, variants, questions that the examiner creates where the independence of internal audit is threatened. In such a case, how do you handle the situation? There could be situations that occasionally arise in which an auditor, especially an internal auditor, might be asked to behave or even tempted to behave in a way that conflicts with ethical standards and guidelines. For example, there could be pressure from an overbearing supervisor, manager or director adversely affecting the accountant's integrity. An auditor might mislead his employer as to the amount of experience or expertise he has, when in reality, the expert advice of someone else should be sought. And an auditor might be asked to act contrary to a technical or professional standard. There could be divided loyalty between the auditor's superior and the required standard of conduct that would need to be displayed. Now, these are just a few examples of how there could be an ethical conflict when an internal auditor is trying to implement their duty. Next, so please keep an eye. Next, we are looking at effectiveness and efficiency of internal audit. The internal audit process must provide benefits in excess of its cost, obviously. So the efficiency of internal audit, you can assess this by comparing actual costs and output against a target, such as the cost per internal audit day, the cost per audit report, the number of audit reports produced. And then we can even measure the effectiveness of internal audit, which needs to be measured in a way that indicates the extent to which it provides assurance to management. The extent, because it's very rare that you can be perfect. So the higher the degree of effectiveness, the better. So that assurance that internal audit provides to the management, the audit committee and the board about the effectiveness of the system of internal controls that are there. This can be done by identifying evidence of improvements in internal control. Next, we look at the internal audit report. Now, an internal audit report can be prepared for many company activities or systems, and it might consider the following. On the one end, at front of the report, there would usually be an executive summary. As most corporate documents, this would cover the main objectives and the scope of the audit, the work performed in brief, and the results found and recommendations made. Then, the scope of the assignment would be elaborated in the next section. This would detail the methodology used, for example, observation, questionnaire, etc., and also the areas covered, the joiners, the levers, various aspects depending on the investigation. The next section could be observations and recommendations. That is what the auditor observed during his testing, whether the system was working as it was designed to, and whether any recommendations should be implemented. It could also say who is responsible for any implementations and by when they should be undertaken. The number of recommendations could range from none, that is the system is working perfectly, to many. This is probably the most practical and most useful part of the report for management, the observations and recommendations section. The recommendations may be graded by importance. For example, you can have a level 1 recommendation which may need to be implemented immediately. So very high priority because it poses a significant risk to the company. Whereas a level 5 recommendation might be desirable but not necessarily business critical, so can be implemented later. Finally, there will be a statement of responsibility from the internal auditor. This will detail any auditing standards, standard tests or rules an auditor should follow, used during the course of the work and any limitations in the audit work that was performed. The statement of responsibility. And the auditor will finally sign the report. The internal audit report is often seen as a trigger for risk management, both in the real world and in the Cima strategic case study exam. So this is detailed later in the slides, but remember the internal audit report or an extract of the report have been used by the Cima case study examiner as a trigger for your questions. So it is an important document. Next, we look at internal and external audit. Now, to a large extent, the work of internal auditors and external auditors is similar and could overlap. It is therefore important that their efforts should complement each other rather than duplicate each other. Comparison. Here you have a snapshot of the comparison between external audit and internal audit. So if you look at the role required by whom, for external audit it's statutory and for limited companies. Internal audit, directors and shareholders, usually in larger organizations. Who are the appointers? So external audit appointments through shareholders or directors. Internal audit, directors through the chief internal auditor. And internal auditors report, or rather external auditors report to shareholders and the management under primary and professional responsibility, whereas internal auditors report to directors through the chief internal auditor. Then reports on financial statements is what external audit primarily focuses on, whereas internal audit focuses on the internal control system. External audit forms opinions on true and fair view and proper presentation mainly of financial statements, whereas internal audit forms opinions on adequacy of ICS as a contribution, that is internal control systems, as a contribution to the economic, efficient and effective use of resources. The scope of the assignment, external audit, it's unlimited to the extent which you need to fulfill the statutory obligation. The internal audit Well, it will be very specific to whatever the investigation that is being conducted, or could be prescribed by the directors. So here you have a comparison of external audit and internal audit. Now let's take a look at the relationship between internal and external audit. The audit plan, which we discussed earlier, of the external auditors must be drawn up taking into consideration the work of internal audit and the extent to which the external auditors can rely on the findings of the internal auditors in reaching their audit opinion. Factors that the external auditor must consider include the status of internal audit within the organization, scope of the internal audit function, whether management acts on the recommendations of the internal auditor, technical competence of the internal auditors, because obviously if you're going to use their work as the preliminary basis, you need to you need to understand the technical competence, and whether the objectives of internal audit work are aligned with that of the external auditor, and whether the work of the internal audit function appears to have been planned, supervised, reviewed, and documented with professional care. Which means that generally, duties of both sets of auditors will differ, and hence the work of internal audit may be of very little relevance to the external auditor. But in some cases, the external auditors do rely on internal auditors' work if areas of the external auditor's audit program have been covered, while the factors mentioned above can be met in the internal audit investigations. That brings me to this important piece of documentation called the management letter. Normally, any sharing of work can lead to a reduced external audit fee because some of the testing has been done internally at a reduced cost. So the management letter, while you produce the audit report, the auditor will usually produce a management letter. This letter usually includes a list of issues that the auditor came across during the course of the audit work. The letter usually includes a table of issues concerning the auditor, usually a control that can be improved, recommendations to implement or improve the controls, and the auditor would usually state a time frame by which the new controls should be implemented, and then revisit the department to ensure that the implementation had taken place. The management are at liberty to reply to the auditor. They even may state that the recommended control has been implemented, to explain why it hasn't been, perhaps because it could be too costly, or even the fact that it's still ongoing. So these reasons must be explained, and that is a snapshot of, or rather a quick look at what the different components within the management letter are, mainly the issues and the recommendations. Next, we look at fraud in terms of the differing perspectives. The external auditor is responsible for identifying material misstatements in the financial statements in order to ensure that they give a true and fair view. Now, by definition, the external auditor is responsible for detecting any material fraud that may have occurred. However, they have no specific responsibility with regard to immaterial frauds. If they identify them, they will be reported to those charged with governance, but there is no duty to identify them. Now, as in contrast, internal auditors may be given an assignment to assess the likelihood of fraud, and if a fraud has been discovered, very specific, to assess its consequences, and even to make recommendations for prevention in the future. So special investigations can be dedicated to fraud investigation that internal auditors would conduct. So how do you conduct a fraud investigation? This can be carried out by an auditor. It is not their primary objective when carrying out an audit, but they are duty bound to report a fraud if during the course of their work they identify any fraudulent activities, because they are the ones who are in the best position to come across any kind of fraudulent activities because of the nature of their work. It is the company directors who are responsible for identifying fraud. So a fraud investigation should cover the following steps. 1. You ascertain the facts of the fraudulent activity. Then you gather evidence of the crime, documentary, interviews with witnesses, observational evidence, etc. Then you corroborate the evidence. Consider whether you have the right of access to the evidence you require. Many cases have been thrown out of the court because evidence has been improperly obtained. Maintain confidentiality so that the perpetrator doesn't realize they are being investigated. Consider the cost of the investigation versus the value of the fraud, although ethically, all frauds should be stopped. Then you ascertain the value of the fraud. Consider the loss of reputation if the fraud becomes public, and take it to your audit committee. Well, the taking to the audit committee will be embedded in all the steps. And that marks the end of part 1, segment 7 on internal audit. As I always say, keep learning and enjoy the process. I hope that in this segment you've gained a significant amount of knowledge in terms of the details relating to how internal audit works, what internal audit has to do, the kind of standards they have to maintain, and all these different connections in terms of risk management, in terms of corporate governance, in terms of external audit, in terms of fraud, all the different connections, because internal audit seems to be right in the middle there. So I will see you on the second part of segment 7 probably. Until I see you next, thank you ladies and gentlemen. Happy learning.